I was looking at gold. This is the easiest way to trade. Find a trend like this. A bull trend is punctuated by periods of consolidation. That's normal. The reason that happens is the whole point of a financial market is for buyers and sellers to come together and execute business, of course. If you want to buy gold, you're going to go to a marketplace where you can find some sellers. It's just like if you want to go buy tomatoes, you go to the shop or you go to the local market because you know you'll find someone that is selling tomatoes. The financial markets are exactly the same. That's why you get periods of consolidation, because the market is actually performing its function. It's found a level where buyers and sellers have come together and the market is fairly stable. So for a market to consolidate and trade sideways is actually perfectly normal. When you think about it, these violent moves in price means the buyers can't find enough sellers to match their business, and they have to keep pushing their price higher and higher in order to find someone who is willing to sell to them. So this is the structure of the market. The market will vacuum up looking for sellers. So gold buyers came into the market, and then this is your initial probe up. Then you get a consolidation. Some sellers come in, maybe some people who have been buying, who are long down here, for example, I don't know, just for argument's sake, they've decided, oh, that's a good profit. I'm going to take some profit on that. So you get consolidation, then you get a spike up, then you get consolidation, then you get a jump, consolidation, then you get a big jump. This is momentum building, really. We're starting to trend up. You do get this kind of acceleration. It's quite normal. And then you get another consolidation. Anyway, you'll get triangle patterns. This is a flag pattern. And eventually the market breaks up and keeps going. Now, we've broken above the previous high in gold, which I think was 1997. I could even put more trend lines on here. There you go. Trend line. There you go. So now we've broken up. Your support is obviously around the 1997, 1992 area, if we happen to get back down there again. So if I was to structure a trade in gold, let's say I put my order in to buy it around 1995, I'd have my stop below 1981. I guess. Yeah, let's say I put my stop in at 1980, just to make the numbers simple. I could have a 15 pip stop loss, but the upside, when I look at the weekly chart, we could easily be getting up to, well, what's the high of this candle? 2024, 2048. So 2045 would certainly be a realistic target. If I bought in at 1995, I could be looking at a 50-point profit. That would be perfectly realistic. If I've got to stop at 1980 from getting in at 1995, I've got a 15 pip stop. So that is at least a 3R potential trade. So for me, yes, that's worth doing. I'm trading in the direction of the short-term trend. The patterns are indicating that we are going to remain in this bull trend. You can see the consolidation patterns, and every time we do and eventually break up, and look at, that green candle is so convincing that I would be very happy to be buying around the high 1990 area. That's the most simple way to trade. Find a trend like that, find the consolidation, and just buy when you break above the consolidation, as we have done here. The other way to trade this kind of bull trend is to put Fibonacci levels on and buy on a retracement. So say, for example, we're here, we've gone up to here. Okay, now, ideally, I would have been buying at 1902. We've hit 1931, but in this case, we wouldn't have got the chance because the market only got down to 1907. It didn't get down to 1903. So I would be buying into a support level. You'd have had to have been more aggressive. You didn't quite get the chance to buy there. Either that, or you buy above the break of the trend line of the consolidation pattern. So when you're trading a bull trend, either you're trying to buy into a support level or you're trying to buy into a break above the consolidation pattern. You can also buy a break above the previous high. See how this high held quite well here with that doji candle, but then 3 days later we broke up with a convincing green candle. So that was your buy signal. If you bought somewhere in that green candle on the break above the previous high and you had a stop loss just below the low of that green candle on the 4-hour chart, the stop would be around 1925. Let's say you got in around 1935, you got a 10-point stop. Nice trade. If you'd have run that, you could have done really, really well. So these are all the little trade ideas you can use for trading a bull trend like that. Trading in the direction of the trend gives you the opportunity to run a trade. Let's just have a look at this one. This is a beauty, if I remember correctly. So this is what I had my subscribers doing. So the market's gone up and up and up and up. Hit a peak on Monday last week at 1996. Now, the obvious trade was to buy it down at 1952 because that's the 23.6% fib. I already know that we're in a strong bull trend. I already know that I want to be buying at a support level. On the 1-hour chart, the moving averages are telling me that we're in a bull trend. I would have been slightly concerned that we'd broken the 100-hour moving average in the blue line, but I would certainly have been keen to buy at the 23.6% fib. We did drop, we didn't quite touch it, so you'd had been slightly more aggressive on that. So the moving averages are telling me that in the short term we're in a bull trend because they're all pointing up on the 1 hour chart. I'll go back to the 4 hour chart. They're just starting to turn. Look, we've got a bullish crossover here. On the 4 hour chart now, a bullish confirmation with the 100 moving average crossing above the 200 moving average for gold. So this does indicate that maybe we have another significant move higher on the cards, and we have just broken above this previous high. We've broken the consolidation pattern. We've held the 23.6% fib. This is all looking really positive for gold, and we could go to 2040, 2045. I'm not saying that we will, but I'm saying there is a very strong possibility. And when you go to the weekly chart, we've beaten this swing high up here. What's that? 1988. We've got well through there. These little peaks of these 1, 2, 3, 4 candles. So that's also quite positive. I mean, for us to get up to 2014, well, we're not far from there anyway. And then 2028, 2045, that really does look realistic when you're in a trend like this. Once you catch a trend like this, you want to be trying to hold the trades and just trail the stops. Keep the trades open for a swing trade. I'm just going to open this up and show you exactly how I would have traded this. Well, actually, how we did trade this. Okay, here we go. So we're in a consolidation pattern. We've made a previous peak here, and I've now got my trend line on what I believe is a flag or a pennant or some sort of consolidation pattern. Doesn't really matter what we call it. Let's say we are watching this market last week. This is Monday. This is Friday. So on Friday, now you're finally seeing a break above the trend line. You know you're in a bull trend. You're waiting for this to happen. You're waiting for the end of the consolidation. Let's say you've bought in here just fractionally above the break. That is exactly at 1994. I'm going to be cautious. I'm going to have my stop loss at just below the low of this big green candle. The green candle hasn't completed yet, of course, because I'm getting in here, but I know the low of the candle at the moment is 1982. I could be really cautious and I could have my stop loss in at 1980. That's just below the trend line that I've drawn there. It's just below the low of that candle. So as I've said earlier, I've got a 15-point stop. Now, by Friday's close, or where we are now, even as 2004, I'm in profit of about 10 points. What do I do now? I'm going to trail my stop. I want to protect myself even further. So I can have my stop loss now just below the trend line. I could have it at, like, say, 98. So I've moved my stop loss up by 8 points, which means I've got a potential loss now of only 6 points. So that's nice. And I know that we could be getting up to 2040, let's say. So I'm now risking 6 points to make up to 45 points. So by trailing my stop, my risk reward has increased in my favor dramatically. If we break above this big green candle, that is at 2009. If you're not already long, you might want to jump into a long. But if you are already long, then you could trail your stop up again. Now, what's the low of this little doji candle? The low of the doji candle is 1997. So I could bring my stop to break even at 1994. And now I've got a free trade. Let's say we're up at 2010. I'm bringing my stop up to my break even point here, which is just below this doji. And it's still just below the previous high as well. So I feel safe. I feel that we should hold above the previous high on a retest, and we did on this candle here anyway. So that's my theory working. So there's two reasons why I would have my stop at 90. A, it's above the previous high, and B, it's below the low of this candle, and it's my entry point. That would be the perfect way for me to trade this bull trend breakout